Let me ask you something direct. When you filled up your gas tank this week, did you notice the number on the pump? When you opened your brokerage app and saw the red, did you ask yourself why? When you heard the word Strait of Hormuz on the news, did your eyes glaze over? Or did something in you recognize that this is not just a foreign policy story? If you are over 40, you have lived through enough economic cycles to know one thing. The shocks that hit hardest are the ones people dismissed as someone else's problem. The oil embargo of 1973, the Iranian Revolution of 1979, the Gulf War of 1990. Every single time the American consumer said, "That's over there." And every single time "over there" showed up at the gas station, the grocery store, and the mortgage statement. Today, we are at that moment again. And this time, it is not a warning. It has already begun. The Strait of Hormuz is not just a coordinate on a map. It is the jugular vein of the global economy. At its narrowest point, it is just 21 miles wide, less than the distance from Manhattan to Newark. And through that narrow passage, 1/5 of the world's liquid petroleum flows every single day. On a normal day, 138 ships transit that waterway. 138. Since late February of 2026, that number has collapsed to fewer than 5. The International Energy Agency, not a political organization, not a think tank with an agenda, but the world's foremost body on energy security, has called this the largest disruption to global energy supplies in the history of the oil market. Larger than the 1973 Arab oil embargo. Larger than the Iranian Revolution. Let that sink in. Brent crude, the global benchmark for oil prices, surged past $126 per barrel at its peak, a level not seen in years. In California, gas prices crossed $5 a gallon. Nationally, the pump price climbed above $4, and this is happening while the Federal Reserve is already trying to manage an economy that was fragile before the first missile was ever fired. The price of crude is not just a number on a commodity screen. It is the cost of making everything. It is the cost of shipping everything. It is embedded in your groceries, your electricity bill, your airline ticket, and the supply chain of every business in this country. When energy becomes this expensive, this fast, you are not just paying more at the pump. You are funding a systemic tax on every single transaction in your life. Here is where it gets serious for the American investor. Goldman Sachs, in a recent analysis, raised their 2026 US inflation forecast by nearly a full percentage point as a direct consequence of this disruption. The Federal Reserve Bank of Dallas published research projecting that the closure of the strait could lower global real GDP growth by nearly 3 percentage points on an annualized basis. In a single quarter, 3 percentage points in one quarter. Now think about what that means for the Fed. They are caught in a vice. On one side, energy-driven inflation is pushing prices higher, which normally demands higher interest rates. On the other side, a slowing economy and a rattled stock market demand lower rates to stimulate growth. There is no good answer. There is no soft landing when geopolitical gears grind this hard. We are already seeing the early signals in the bond market. The yield on the 10-year Treasury note has climbed to 4.4%, reflecting the market's anxiety about inflation running hotter for longer. The 30-year mortgage rate has moved to 6.38%. For anyone thinking about refinancing, buying a home, or funding a business expansion, that number is not abstract. That is money directly out of your pocket, courtesy of a crisis unfolding 7,000 miles away. Oxford Economics has gone further. They modeled a scenario where oil averages $140 a barrel for 2 consecutive months, what they describe as a breaking point for the global economy. At that level, global inflation could reach 5.1% and global GDP would contract. That is not a doomsday fantasy. That is a mainstream economic institution stress testing the math. Now let's go one level deeper, because this is where most financial media stops short. For decades, the United States has wielded the US dollar as a tool of statecraft, sanctions, secondary sanctions, exclusion from the SWIFT banking system. These are the modern equivalent of a naval blockade. And they work until they don't. Here is the paradox. Every time Washington locks a nation out of the dollar system, it hands that nation the most powerful incentive imaginable to build an alternative. Tehran knows this. Beijing knows this. Moscow knows this. The result is a slow, deliberate construction of a shadow financial infrastructure. Non-dollar oil trades, bilateral currency agreements, and an expanding BRICS Plus framework that is explicitly designed to reduce dependence on the American financial system. Iran, even under maximum sanctions pressure, continued exporting oil, largely to China, priced outside the dollar. As the current crisis has unfolded, Iran has selectively permitted passage through the strait only to vessels linked to China, Russia, India, Pakistan, and a handful of other nations. The message is unmistakable. The world is being divided into financial blocks, and the dividing line is access to the most critical energy choke point on Earth. This is the Econ Paradox. The very instruments the United States uses to maintain its dominance are accelerating the formation of the alternative system it fears most. De-dollarization is no longer a thesis discussed in academic papers. It is a strategic reality being written in real time, in the shipping lanes of the Persian Gulf. For you, the American investor, this carries a long-term implication that transcends any single news cycle. The petrodollar system, the arrangement that has allowed the United States to export inflation, borrow cheaply, and maintain a standard of living above what our trade balance alone would justify, is under structural pressure. If that foundation erodes, the cost of capital for every American business and every American homeowner eventually rises with it. The first step is to bury the optimism of the 1990s. We are no longer in an era of a single unchallenged superpower guaranteeing the free flow of global resources. We are in an era of competing blocs, weaponized supply chains, and energy as a geopolitical instrument. The rules of asset allocation, written for a unipolar world, need to be rewritten for a fractured one. What does that mean in practical terms? Energy and commodity exposure are no longer speculative positions. They are insurance. Hard assets, by definition, hold their value when paper currency is being inflated away by supply shocks. The countries most insulated from this crisis are those with domestic energy production. And the companies best positioned are those providing the infrastructure for a world that can no longer take resource access for granted. Conversely, businesses and portfolios that are built on the assumption of frictionless global logistics, stable energy costs, and a cooperative international order are now carrying a risk premium they may not have fully priced in. Morgan Stanley has been direct. A protracted conflict in the Strait of Hormuz could box in the Federal Reserve, increase the odds of policy paralysis, and put upward pressure on long-term bond yields. A headwind for both equity and fixed income assets simultaneously. When stocks and bonds both face pressure at the same time, traditional 60-40 portfolio logic breaks down. This is not a call for panic. It is a call for clarity. Here is what 40-plus years of living through economic history should teach you. The moments that reshuffled generational wealth were never the moments that felt like crisis on the television screen. They were the moments that looked like background noise to everyone who wasn't paying attention. The 1973 oil embargo created the energy industry fortunes of the 1980s. The stagflation of the late 1970s rewarded those who held real assets and crushed those who held long-duration bonds. The Gulf War of 1990 was resolved quickly, but it still repriced risk for a decade. The Strait of Hormuz crisis of 2026 is not background noise. It is the clearest signal in a generation that the global financial architecture is being stress-tested. Whether you're managing a 401k, running a business, or simply trying to protect the purchasing power of what you have built over a lifetime of work, this is the kind of event that rewards those who see the board clearly and punishes those who look away. We do not offer comfort here at Econ Paradox. We offer perspective, the hard kind, the kind that actually prepares you. If this analysis challenged the way you see the world, share it with someone who needs to hear it. Subscribe to stay ahead of the next move. Protect your capital. Mind the horizon. We will see you in the next deep dive.